Welcome to the Crypto Compliance Podcast by Gatenox.
Welcome in Crypto Compliance by Gatenox. My name is Paweł Kuskowski and I'm hosting this podcast. Please welcome today Nick Andrews. Nick Andrews is the go-to person, the go-to expert in compliance, especially in the area of crypto and digital assets in the UK. He has extremely good experience in this area. He served as a director in Binance UK and Crypto.com. Please welcome Nick Andrews. Hi, Nick. How are you?
Good afternoon, Pavel. Very well indeed. Thank you.
Listen, thank you very much for having this recording with me. This is Crypto Compliance by Gatenox. And I'm Nick. I'm very pleased to have you on this, especially with considering your knowledge and your experience in the UK and in the crypto and compliance space. So without any further delay, let's jump into the landscape in the UK. What's happening from your perspective in the UK? Is the UK actually the country where you want to start your next crypto project, Web3 project, or it's quite opposite? You would say that there are some better jurisdictions and UK is actually delaying the process or not following through the process. And one background to this is, from my perspective, I know that many governments would say, oh, we want to be crypto friendly, we want to grow the crypto business, but I don't see this happening for a number of years. I think it's the first conversation which I had was 2016, with Bank of England at that time, workshops around crypto. So where do you think we are at the moment?
Well, I think you've come up with some of the things I was going to say. There is just grindingly slow here in the UK, where we're seeing that dichotomy between the UK government publicly announcing that they want to become the crypto centre, the most innovative. It's all great for the financial services sector. All of those sorts of things. And of course, there's a good number of other governments saying exactly the same. Saudi, UAE, they're fighting for it over there in the Middle East, and various other countries which are on the front foot, particularly France, I could say as well. But from the UK's point of view, that's the objective. But why isn't it being carried out? And I could argue, and I'm not going to defend anybody, but I could argue and say, well, take a cautious approach and make sure you get it right. And that's the way that we've always done it in certain innovations here in the UK, and particularly in the financial services sector. I can't really talk about other countries if I've spent most of my career here in the UK. So that's the way that we've always done it. But this is a very, very different industry. It's moving very quickly. You know that as well as I do. I'm sure the listeners are far superior on speed than I am on these sorts of things. But the technology is changing, the products are changing. Where are they? What are they doing? How on earth does a regulator keep up to date with all of these things when there's the expectation of legislation has to come out? Bear in mind, we also have to have the supporting tax legislation. So all of these things come into play. It's got to work its way through the system, and then it gets delivered to the regulator to say, go regulate. And that's where I have the particular problem of speed. The original requirement was commonly called the 5AMLD, or the VASP registration, which we had a similar registration process here in the UK under the Payment Services Directive, which was managed for anti-money laundering purposes by HMRC, the tax authorities. That was pretty quick. All of those firms that were registered with the FCA in the payments world had to be dual regulated, or registered rather, for financial crime or money laundering by HMRC. Quick and easy. It pops into the FCA's box, and what was assumed to be a registration becomes a full-blown, very expensive in time and effort authorization process. One size fits all, whether you're regulated, existing regulated or not, whether you're coming from the brokerage side, the custody side, the derivative side, whatever it is, one size fits all. Grindingly slow going into the FCA. We can look at the history of those sorts of things, where originally there were apparently 300, 400 firms to apply for this registration back in January 2020, I think it was, which was odd because I was actually had on my list about 750 firms operating in the UK in the crypto space. So it was an underestimate there anyway. But how many have got through in that time? It's probably around about 50 now. That's not really showing innovation and speed. Do understand it to an extent from the FCA's point of view of they've got to get it right. But really, is that the right model to be done? And that, of course, is a sort of the part of the background to your question. Is the UK the right place to go? Well, having always worked in this financial services sector, the coming to the UK and setting up in the UK, we've got everything going for it in theory. We've got the experience, the people, the support mechanisms. English law is really helpful. All of those sorts of things are there, which is a benefit to starting up. Yeah, I can criticize the way that we don't have quite such good capital raising pieces as Silicon Valley has shown. But that's not part of the regulator's problem necessarily. It's risk appetite. So it should all be good to set up here, but it's just too hard. And particularly when firms want to move quickly, they've got a plan to launch to try and make some money. It's expensive to set up. And then you're on 12 months, 18 months waiting for the FCA to even look at your case, which is then devastating. Having people employed in that time, because you've got to be ready, willing, and able to start in the crypto space as soon as you put your application in. You're financially skewered, and a good number of them have fallen out of, had to close down because they simply can't afford the waiting game. Didn't even have their registration looked at. Funny that, isn't it? Now that doesn't really say much. Is it a good place to do business? I think at the moment the flavour is not really. It's far too hard. Not wanted on voyage is really the image that is given to set up here. It's been easier to go to Switzerland. It's easier to go to some other jurisdictions. Do those jurisdictions really matter? I take that for a pinch of salt, as when I say, yes, of course, some jurisdictions are quite difficult. But are investors, are participants really looking at where the jurisdiction is of a crypto firm? This stage, probably not, because it's a limited supply. As the industry changes from, and it's changing as we're watching, where the initial flush were retail driven, and it's worked its way up the category of participants into it. It's now much more corporate, investor, etc., etc., etc. Then jurisdiction will matter. But as I've always said, it's very hard to attract an investor. It's very hard to keep an investor. And once the money goes overseas, it's very hard to get it back again. So Coinbase, prime example. They could have been here in the UK, but they're not. They're Irish-based, and which is where they've raised a lot of money, and now they've had some approvals for certain crypto things in the US.
Yeah,
they could have been here, but they're not.
Well, is Circle originally UK? I think originally,
I think it was.
It started. So you could have, British pound being, the main USDC corresponding, currency, if Circle would stay in the UK, so that would be probably very, very interesting, right? And what's the reason? Do you think it's, there's theory which is like, okay, because the traditional financial UK market is not ready to open for competition, and that's the biggest blocker. That's one of the conspiracy theory that is functioning in the UK. The other part is FCA weakened by many people left, many good people left in the last 3 years.
Yeah,
FCA, and it's almost kind of the follow on Brexit, that there was big impact to the FCA being not able simply to kind of understand what's happening with crypto, so they simply reject this. What's your, is there any theory you have, or you just would simply say it is what it is?
Well, I would say that, but no, you're right. The FCA has been affected, I would suggest, by the pandemic as well. A lot of people working from home, and that's across a lot of industries, not just specific to them. Their ability to not risk failure, and that possibly comes out from the LCF, the mini bond piece, the failure of that. I actually was supportive of the FCA in that, but not in how the outcome came out necessarily. That's a different story. But that gave the FCA a lot of negative press, and perhaps at the senior level, well, we don't want any more errors, or I'm not suggesting that was an error on their behalf, any failures on our hands or on our watch. Well, take a much more brutal approach, particularly as where does the experience come from in the FCA immediately to start looking at this very significant and very broad new industry that started up from almost nowhere, and get your arms around it, understand it, whilst you're doing all the other things that you're having to do. Very difficult from their point of view, but that's the expectation on them as the regulator, is that we need you to be a lot more proactive and pragmatic about this situation. Maybe they are working on that particular piece, but they're going to have to show it a little bit more.
And so currently we have, I think, the critical element, which is the customer protection regulations in the UK, right? Which makes sense in terms of what you should first do in our space is to protect the customer, right? But at the same time, my worry is, and this is how I see this, considering other projects, is that if we don't clarify what is consumer product, right, and we simply treat every crypto product as consumer product because we don't have any other differentiation, right? Like, for example, we are planning to launch the NFT wrapped license, which is typical B2B product, but I'm worried that it's going to be caught up in the consumer protection regulations, right, and promotion. What do you think? Is this the right approach? Or, for me, it's initially was good idea, but the more I think about it, the more risk we create because we don't have the answer for the rest of the puzzles in the space.
Well, the compensation scheme is provided for certain regulated products and activities. For example, depositing at a bank account has some compensation there. Safeguarding of these sorts of things for retail clients is where it steps in. For professional clients, it's the compensation scheme is not necessarily there. But the point there is we have to differentiate in the crypto space what is falling definitely into a regulated activity. That's anything that's a derivative. So a derivative goes over there. If it's a retail derivative, bearing in mind they've been banned for crypto, for retail clients, the compensation scheme was there because you had to be FISMA, or Financial Services Markets Authority Act, rather, regulated, Part 4 permission. So you're a securities broker, and you then have to have the license as well, as we just talked about. But that's fine. Derivatives, crypto derivatives, then would fall alongside rolling spot and CFDs for retail clients. There's that element of compensation that's there because you're into the to the regulated sector. But the spot crypto activities, not regulated, same as the LCF mini bonds, they weren't regulated. So as long as the individual in this country knows that that's the case, that's the problem. Where we seem to be getting a bit mixed up, and here's a really opinionated piece coming up, is that we've tended to nationalize risk in this country, so nobody's allowed to take any risks, and if they do, somebody's got to pay for it, whether that's in the financial services sector or somewhere else. And that's the big problem that we seem to have, is that there's the expectation that anybody who touches a company will get compensation somehow from it if something goes wrong. That is made worse if a crypto firm which has got registered by the FCA on their website, and in the small writing underneath saying, but this isn't covered by compensation, the typical UK citizen says, well, said FCA, I thought it was. Back to the LCF mini bonds. They got an element of compensation when arguably they weren't supposed to.
So what you're saying is that, in other words, that because we are in the space, we want to protect consumer, anything which would be bringing any risk to them someone have to kind of compensate in case things go wrong, right?
Well, follow the route over the past 10, 20, 25 years that when the financial sector comes up with something innovative for whatever reasons, and the innovative piece means a greater reward. If you have a greater reward, you've got greater risk. We cannot break that cycle. That if you're going to get a bigger reward, you're taking greater risk, obviously. But what we've tended to do here in the UK with all of these different ways for individuals to make a greater return on their money, be it, we've had, I referred to them earlier, retail derivatives, we've had buy-to-lets, we've had film finance, we've had all of these different pieces. As soon as there's a little bit of risk, it gets clamped down. And you're not allowed to invest in these sorts of things or participate in these sorts of things because Big Brother knows better, and you cannot take that risk. You might lose the money. So where do people go? They want to take a bit of risk. They want a return. I know the interest rates have changed somewhat, but when there was nothing being paid on your deposit account, people were piling into the mini bonds, for example, paying 11, 12, 14%. But they didn't realize there was risk there. Really? And now the risk is being chased offshore. So people are now moving overseas and not moving overseas themselves, but buying product from overseas. Well, that's okay. That won't come out of the UK compensation scheme. And arguably, the regulator can turn around and say, we told you not to go overseas. Your fault. Yeah, that's fine. I have no problem with that. But again, people just do not read or want to comprehend that they're taking risk on, or what the risks are. I think I'm probably one of the only people who actually does read some of the terms and conditions and other pieces to find out where that entity is. And sometimes it's very hard to find out, of course, and we know a few examples of that in the crypto space. Yeah.
No, for one of the podcasts, I've done analysis of top 20 exchanges, and all of them are Cayman, BVI, or this area, except, I believe Coinbase. And I think Kraken was also in this packet. The rest was, simply offshore, or Malta. And
then if you go beneath the top 20, they've got some very interesting countries as to where they are. And I always turn around to people and people say, well, what do you think of this exchange? Well, where is it? Well, would you send your money to a bank account over there? No.
Exactly.
So why are you asking me?
Yeah. No, that's true.
Yeah.
But it is always risk, I find that's another, risk that someone simply put, like with Binance, right? And I don't want to pick Binance in general, but Binance is great case, that it's very difficult to find out who is your operator and where they are located. And that's done on purpose in general. So it's complex, they like obviously, a lot of money, a lot of, jurisdictions coverage, one engine at the end, which is covering all these different jurisdictions. But onboarding entity could be in Switzerland, in Korea, BVI, Malta, wherever, right? So I think it's not even sufficient in terms of understanding where is the entity located, because the entity could be different, right?
Yep.
So that's tricky, and that's for people in compliance space who understand what is the risk associated with these different jurisdictions. So that's something which is crypto, right?
Yeah, if I could just interrupt you there, that model in a perhaps more simpler way is exactly the way that a lot of the CFD and retail brokerages operated.
Okay.
Have the face here in the UK or wherever it may be, and have the B book who you're actually transacting with in a jurisdiction, which I've seen some crazy jurisdictions. I say crazy from a risk point of view. And why are they there? Capital. It's cheaper to have your capital there that you're trading against than it is in a full fat regulated area where the capital requirements are significant. You make more money, and the users don't realize where you're actually trading.
Okay, that's interesting. So you say that historically there are already sectors which operated in this way, right?
Absolutely, yeah.
Okay.
Yeah.
So there's nothing new for crypto. So why we are concerned with crypto, right? In this
exactly. Using your examples, yes, of course, it's different when you're onboarded here, but that's just efficiency, cost efficiency, those sorts of things. And Binance is not regulated. You use that example because it's not a regulated product. So arguably, build it as the most efficient way that they can to make as much money as they can. And, tax efficiency too.
Another point is, I find this also, very interesting. It's not, you almost have to have PhD in compliance to understand, jurisdictions, then, licenses, because you could be onboarding into the payment processor, e-money processor, which is, it's becoming very popular, right? The e-money processors right now for crypto. So the onboarding, or even if you have, their website would be like, oh, it's a store, located somewhere, but it's a front for, crypto payments, right? And it's something which it's very difficult to find out, to understand what are the risks associated with this.
Yeah.
So is there any way you think, we can, how we could go about this as an industry to tackle these problems?
Well, that's an interesting question because, as is usual, making a very general point there, is the good guys will do the good thing and display where they are and do that. And the bad guys who pay a better rate won't do it and will ultimately screw you. Who follows that? Nobody ever believes they're going to lose money when they first move into these things. So I'll go for the rate. Good luck. And the old adage of a fool and his money is always parted. And I know some very sensible, qualified people, wet behind the ears, who've been suckered into crypto scams. And when you actually look at the scam itself, just crypto is just the name. They're not actually crypto companies. Yeah. They are just genuine Ponzi schemes to take your money, or pyramid schemes to take your money and just, crypto is fashionable. Therefore, it pays has the potential to pay significant income. Forget it. Your money never even went into crypto, and it's just gone. I think we all know those sorts of firms. So the problem is always going to be who are the good guys and who are the bad guys. And at the moment, we've got however many on the crypto register here in the UK, which are ostensibly the the good guys. Well, they are the good guys because they've got through the registration process. But there's an awful lot that have gone overseas or are good guys but couldn't get it through here in that time for whatever reasons. There's an awful lot of bad guys out there, which are not crypto guys, not real businesses, and some pretty dubious crypto businesses, I hasten to add. But they're never going to tell you what's going on. It's a tough one.
But ideally, when you think about this, and just what I hear is that as a government, you should be supporting a couple of players on your market locally, where that these are good guys. The risk associated is under our control, and we support them to grow, because otherwise people would go somewhere else.
Yeah.
Right? This should be kind of meaningful way to sorting this out. Like, obviously, if you are, I've been trading crypto since, 10 years, right? So I know all the risks probably associated with this. So it's almost like, there is an element of gambling in crypto, right?
Yeah.
And it's almost like, even if you talk about stable coins is fine, it's completely, it's safe place. Tether, USDT, all this stuff, is it safe? You could argue, right? You remember when there was the banking closure in the US recently, right?
Yep.
And the USDC went down 10%, in one day. That's 10% gone from your value, right? Even in the stable coin supported by Circle, by the US government. That's effectively was very interesting as well, how the market reacted, right? So that's really interesting how you what's the crypto market is in reality, right? And that's something like what we can do about it. Nick, how did you get into compliance first and then into crypto? Tell me your story.
Probably don't have enough time if I gave you the full details, but I'll get down to the high level. I started in the banks, the traditional banks, many years ago. And I moved from project finance, which was very interesting, into the credit world, credit risk. I ended up running the credit risk management function in a small bank. It was a commercial bank and derivative trading bank. And then I moved to the capital markets side. I moved for the bond floor. And then I was on the equity floor. I moved to another company, which was fabulous company to work for. An American-owned company here in London, which was multidisciplinary. We brought ETFs to London, so it just shows you how long ago that was.
Yeah.
And I ran credit risk, legal risk, all the risks apart from market risk, and we set up a derivative clearing entity in that one. And then it came about that from that I became the compliance officer, money laundering reporting officer. I then set up a compliance and regulatory consulting firm. That was 20 years ago. I sold that a few years ago. And it was then when I was in that consulting firm, we did a lot of institutional-based startups. We didn't really deal with retail clients. So got to understand how these things actually worked from a regulatory point of view in terms of capital risks and across the spectrum from banks. We did a couple of bank authorizations did a lot in the retail derivative and payments and those sorts of things. And during that, I was asked to be money laundering reporting officer and a compliance officer for some firms. I'm quite happy to do that. Set up my own regulated entity, which I did sell to a crypto firm, one of the big ones. It was pre-pandemic, probably about 2016, I think it was, where a couple of friends of mine, we set up a crypto lending business, but to make it institutional. So I suppose it would have looked like Alex Mashinsky's Celsius, His was much more retail and lower level. Ours was higher level in terms of the amounts, but the funding that we needed to do that was very difficult to get hold of, and then it petered and withered on a vine. So we didn't actually launch it that well, but got to understand the crypto risks. Do you remember? I came from the risk side in those days, and then I joined up with a good friend of mine, and we set up with another guy who I'd worked with on who was a trader, proprietary trader. We set up a crypto proprietary trading, algorithmic, if you like, company, which I looked after from a compliance point of view in my regulated firm as well. And we did some crypto work there, but then that was sold just at the beginning of the pandemic to a big name, all good. And so I'd been participating in the crypto space for a long time. I never traded. I referred to a fool and his money is easily parted. I think if I was given a keyboard to trade crypto, that would be game over. I'd be divorced straight away. But so no, I look at it from that point of view and support it from the risk side. And that's brought me into a lot of very interesting projects because ultimately there are parallels to most of the other traditional finance products that are out there. It's just a different piece. So I get involved. I get involved in some very interesting pieces, and I can tell you about that later on if you're actually interested.
So, I mean, first, congratulations. That sounds like, really, really proper, exits and proper, let's say, story, because this is like, there's not so many compliance people who are can accept risk of running business, which is a pity, because many of the compliance people are, ethical, right? And they understand business and they understand regulations, which is not so many, and I think if you get these components right, you can run really good business and really understand, the risks.
I think part of that is, the FCA has been, it's called a principles-based regulator. And essentially a firm will say, well, how much risk do you want in compliance? If you want no risk, well, you're never going to make any money because we'll smother everything. Yeah. So that's that piece there. So when I was doing the compliance consulting, that was a question I always used to ask. How much risk do you want? More risk, more monitoring, more compliance, done properly, pragmatically, and measure it and deal with it. But because I saw all of these different companies and the different appetites for risk, I wasn't modeled on just one company, where if you tend to work in compliance in one company, that's it. And you don't see anything outside your domain until you move on. So that's why I did it. That's why I think it was.
I think that's excellent point. And I completely agree with you. There's interesting. I saw this interesting dynamics when you remember compliance used to be kind of nobody wanted to do compliance. It was completely hidden. Then it's gradually grow up to really big part of the organization, right? When I was in RBS, there was 11-12% of total RBS was people related to compliance, and the costs related to this, I think it was around 25%, which is ridiculous, I think.
Yeah, absolutely.
At the same time, people had to, it's almost like proving themselves that they are needed. So there will be, a lot of risk discovery, all this stuff. So that's interesting things. And I think over time, compliance became, and I trained over, I think, 1,000 people in my career, like through different trainings. I met them and, we spoke, we've done a lot of conferences, and I start to hear from compliance people very effectively. If you ask them, who is responsible for business? It's like, oh, we are, right? And I said, no, you are not, you shouldn't be, right? That's exactly, and I think the point which you said is like understanding the risk, and the scale can be completely different. Then applying right tools, right policies, procedures, all this stuff to come up with something that works, and that actually brings business, and that's something that I think it's worth reminding, to compliance officers that that's the way you should be operating, as opposed to, oh no, it's a client who is I don't know, coming from Poland, and that's high risk, because it's close.
It's very easy to be a business prevention officer, which is, that just looks a bit too hard, because you can't argue with me. I'm the compliance officer. That's it. It's a bit too difficult. Move on, and that comes down to, well, you're never going to make any money.
Yeah,
and you see that in the capital markets. Well, everybody's going to chase the big names. Well, you're not going to make any money out of them.
Yeah.
There's simply not enough margin to deal with them. So make up where you want to go to and focus on that. Yeah. Just risk reward every time.
Exactly. So now coming to the compliance, specific compliance section, considering your experience, if you come to the company, right, and let's say this, operating company, and we said, okay, we want to have things done in the right way. So we ask Nick, who is, the go-to UK compliance person, right? And, we ask Nick what we need to do. Where would you start? What's your, let's say, approach in this type of situation? To create framework, policies, procedures, people reporting, all that, there's many, chunks to this. How would you approach this?
Well, I think it's important for regulatory purposes, of course, is that it's we're much more required to abide by the evidence of what you've just described as a responsibility map. So that's the people who do that, what do they do, and where does it go? Not applicable to all firms, but it's one thing that I actually think is really good, and I used to make every firm do that because it shows who's responsible for what, up and down. We put one in for a company a couple of years ago, 128 staff. There were 56 people who were IT people, but nobody controlled them. Well, how do you know the technology is being rebuilt?
Yeah, I'm just thinking about my time in RBS, and I tell you, you know RBS very well, right? And I tell you a funny story. I'm just thinking, how many years passed, and if I can be sued or not for this, But there was part of the markets and international business segment of RBS, and we couldn't identify who is MLRO for this group.
Whoops.
Exactly. So roles and responsibilities. I'm almost like, so we were trying to discover, so who is actually sending things to FCA, to I think at that time was the reports, the MLRO reports, who is sending this information? There's also, there was problematic to find, but at the end we find, okay, so that's our MLRO.
Exactly. So I always find a responsibility map is very useful. Now that's an output after that, but what I always say to somebody who's starting up, or somebody who's expanding, or somebody who wants to add something in, is draw the flow of the business that you think it is. Show me where the money is, show me where the orders go, and what ends up where. And I do that still. I actually did it this morning for somebody. And once it's down on a piece of paper, then you know where the gaps are. Then you know it's when people just say, oh, well, I'm just a broker. Well, there isn't such a thing as just a broker. Who are the participants? Where's the money going to go? Who's going to hold the asset? Who's going to do this? Who's going to do that? Do it with crypto as well. What type of wallet is it? Who has the controls over it? Where's it going to go? Who's going to do what? Comes back to your original question: is there any protection over it? And if it's a security asset in there, all of that sort of stuff, draw it out. Now I build the model around that, because that's what you need to monitor. Where are the gaps? Where are the weaknesses in that? And where are the high risk pieces? The high risk pieces in the regulatory world is always going to be retail clients. Fine, not dealing with them, or you are dealing with them, and client money, client assets, because those are the bits which are there. Get your reconciliations wrong on that, you're going to go to jail before you even start conceptually. So that's what I always do, and then you focus again that risk piece on where are the risks, and make sure those are built properly, and the rest generally, because I'm old and I've been around a long time, generally follows suit. You can do that. So I'd argue that there's not a lot of difference between what I've been doing for 100 years and what you do for a crypto firm that starts up now. It's the same sorts of processes. It's the same sorts of protections and X, Y's, and Z's that go in there. The important thing is do it up front. I've seen so many firms fail, and I mean that could be fall out of business, or fail doubling their costs of startup, because they always put financial crime and compliance at the back end because they think it's that's easy. We'll just use a piece of technology to do that, and it wasn't built in the first place. And they're using that drawing a picture of the flow. You'd forgotten about that bit. Now you've got to go and re-engineer it again. Well, we're going to launch next week. Good luck. You have the regulator all over you. So when you build it properly from the beginning, and it pays dividends. And you also ask them what's their future strategy. What is it you want to build? So if it's a spot crypto firm, do you ever want to go into derivatives? What type of derivatives? How do you think you're going to be doing those? Because that will change the build and the foundations today. Or lending or credit or whatever those other aspects of it may be.
And when you draw this flow, what would you focus on? Where is decision, taken? What's the like from the practical perspective? So
well, I would actually show you, because I've got a pile of papers here. I've drawn them, and I always put them to one side because I always regurgitate them another time and say this one's slightly different. But you're right. There's an interaction between all of those. So where does an order get executed? How does that come into it? How do you actually approach the client? All of these pieces get put into there, and whether it's and crypto firms tend to be technology heavy, people light, whereas the traditional ones are people heavy, technology light. Despite, and I say that on the basis that they may have tons and tons and tons of technology, but it doesn't actually work together in most cases. It's stitched together. And if we think about, well, you mentioned one, but some of the bigger banks, some of their technology goes back 60 years and possibly even 70. From Cobalt Blue, I think, was the original piece that goes in there. And everything's been piled up on an inverted pyramid. It's destined to fail. But a crypto firm will build it from scratch in a sort of a spiral type basis, and it's far easier to do. So I think there's a massive benefit to modern technology, and that gives a margin advantage against the incumbents just purely on technology. But how do we look at those? Then you know who is doing what in that process, and somebody needs to oversight it, whether it's a black box or whatever it is. Hence the responsibility map. Well, if it's in operations, what are they oversighting in the operations? Well, 10 people or one person and what have you. Pick finance as a prime example. Who's in charge of finance? Who's looking at the books? Who's doing the 4 eyes on it? Who's signing the electronic payment out? Don't know. These are all the places where gaps can occur. And a number of times, as a simple one there, have you got 4 eyes on virtually everything to double check people? You used to be in the financial crime and fraud area. The number of people I've seen said, oh no, we just had one person doing it, and that's why you've lost the money.
And is it exactly the same as business flow, or do you think it's like kind of compliance business flow?
It's both, because I turn it around and say it's not compliance first, which is designing the business. You design the business, and I'll tell you where it could either be made more efficient from a compliance point of view, or where your risks are or your gaps are. Yeah,
100%. No, I think that's brilliant. And not so many people understand. That's the funny part, right? This is.
Don't tell everybody how to do it, because I'll be out of a job.
100%. Okay, so listen, where do you think crypto is going? in general?
Well,
What's the is it going to be surviving, or is it going to be growing, or do you think it's going to be still? I mean, today we have, again, Bitcoin down 10%, altcoins, going nowhere. So where do you think we are, and where it's going to go?
I'm in 2 minds on cryptocurrencies on a regular basis. Yes, I've got some. I don't trade them. I just move them occasionally. That doesn't count as trading in my book. So I personally, I think I'll keep with them because I believe they will go up in time. I don't touch certain altcoins because I see no point in them. I can't be bothered, and I don't have time to read the white paper and take that sort of risk. I've got better things to do, really. And with the amount of money that I put in, it wouldn't make me rich anyway. So, but if we broaden that out to digital assets, now that's a very interesting space, and that's where the future is, of which cryptocurrencies are a constituent part. Which parts are there? And I think we're still trying to fathom that bit out. I did quite a lot of work with a couple of other people on a UK-based bank-issued stablecoin. And I can really see where that could step in and make money. There's lots of others are now doing this. And of course, the first person to do it has the cost and the risk, but makes the lion's share of the margin when it begins. Then when everybody else comes in, the margin shrinks down. Yeah, of course it does. So there's no point in chasing somebody who's fifth on the line. I
don't know if I told you that initially, when during CoinFin time, we had client Mitsubishi Bank, MUFG Group, and 2016, which is crazy, when you think of this. 2016, they came up with this idea, MUFG Coin. And we've been supporting this project for over a year. Then IBM came along. All this stuff. But the idea and benefits of this type of coin was extremely good. Because I mean, if you think about client acquisition, right? Your client acquisition in this particular case is, you make it available on the blockchain, which is accessible through the wallets they have. Yeah. That's what you need in terms of client acquisition, right? Because if this is like yen, it's supposed to be one-to-one with yen, this MUFG coin, right? So there's fully supported by the big financial group, yen on blockchain, right? Traded internationally, so in terms of the number of transactions, it could be Tether, the project died, but from my perspective, it was unbelievable. And the mechanism which we were planning to do there, in terms of like assets freezing, like all extremely efficient process, right? So there's like, if this would happen, I don't know. I mean, it could be like yen-based Tether, right?
Yeah. Well, that's the positive side of, or the purity of what can happen, as long as the good guys run it. So that that makes eminent sense. Some of the stable coins make eminent sense to remove the friction out of the way things are conducted around the world. Put that into the wrong hands, where you've got some of my coin and I don't like you, I'm just going to burn that. That's you done. That's controlling authority
right now, or
I haven't used any names at all, but it has that benefit, and we're seeing that in what's happening with just curtailing people with free speech. Well, just think if they actually had their hands on your wallet, and they could not only stop you speaking, but close your account and take your money because they've just been burnt. That could happen. That's one of the problems that we face. But coming back to your point, there's also a much bigger issue on this, which is global politics. We have the US with the dollar as the reserve currency around the world. Oil is backed by the US dollar, not backed, but it's priced in that. Saudi talking very closely with China. Imagine if it's priced in renminbi rather than that. Does that weaken the influence of the US around the world? Does it mean that some of the parts, the tools that the governments can use, particularly the US in terms of sanctions, is that weakened? Does that then allow the bad guys to rise up further than where they are now? There's some big questions out there, way beyond our comprehension that we would be allowed to address. But in the purity of it, yeah, it all makes sense, but it's not going to be allowed to happen in certain cases.
What about NFTs? What about, there's this, property, wrapped in NFT or in tokens? What do you think? The real life assets or real world assets?
I think there is a purpose there. It serves a purpose, and I've got some as well, which are useful for the purposes of their membership cards. And I can share the membership cards in our company so that we can all go and do things like that. I get that. I get it when it is something where the asset is valuable. For example, a Picasso, then 2 million of us could own a little piece of that. But it still has to exist somewhere. It doesn't mean I can have it on the wall, but I do have a piece of ownership so that if it then gets sold at a later date, try and get 2 million people to agree to it, depending on how it's managed, you get a return. I get that. What I don't get is the kiddie computer blips, which are just nonsensical. Hopefully they've all disappeared now. Somebody's got a hole in their wallet for that. Good luck. So I think that as again, it's sort of clearing out the beginners and moving into the next phase, where I'm a big believer in, may not necessarily be an NFT, but that's just the representation of what it is. I'm a big believer in digital assets as it is, and look at some of the exchanges that are starting up, look at some of the really good ideas to tokenize real estate. Unfortunately, we can't do it here in the UK to the way that some of these things do. And I can see that's where the government needs to be very careful. And I'm using an example here where you could put your house into the NFTs, into this particular exchange. It's not an exchange, it's a trust structure. And then depending on, I want to raise some money, I could sell you, 5% of my house and you get ownership and pay it back, all of that sort of stuff. The problem is, I would do that at the drop of a hat, except stamp duty. Yeah. Here in the UK, I'd have to pay stamp duty. But once it's in, I can then pass it on to my children, to you, to, do all of those sorts of things that I've said. But what will HMRC think? Then you're not going to have any more stamp duty if everybody did that here in the UK. That's going to be a big hole in the tax. Yeah. So what are they going to do? Somewhere along the line, they're going to skewer that sort of model because they're going to want capital gains or goodness knows what else on it. So looking forward, am I saying I've actually just killed that business by saying that rather than allowing it to blossom and flourish when I'm a big believer in it? And it's done by, it's just NFT. Here's 5 NFTs, Pavel. You can give them back to me when I've given you the cash back or whatever else it may be. It's going to be very interesting space.
Ideally, you could actually almost, wrapped. It could be kind of loyalties, the stamp duty, right? Which is already in smart contracts, which is operating. So there is a way to do this and actually protect it. But I completely agree with you. But there is something.
Well, it wouldn't generate stamp duty in that particular case because the actual asset never changes hands because it's lodged in a trust. You just get the rights to it. So very, very cleverly thought through.
But so why it's not happening? Because the kind of traditional segments would be opposing this. You think?
It's there's probably three reasons. One, most of us have got a mortgage on our house. The second one, and therefore the bank wouldn't allow you to do that. The second one, that would be quite interesting actually, if the banks then decided we would lend against that, and we would then actually own 60%, 75% of the rights to the house. And every time you make a repayment, it just reduces that percentage down a bit. But that would take a very innovative bank to take that, to do that. I think the second piece is, you own a house here in the UK, which is worth X £100,000. And I'm going to put it into trust. That's a bit of a novelty. I don't want to be first. I don't want to be second. We'll see that go. So I think it'd probably be run more by the commercial property before it gets to residential. And then, of course, you'll have regulations and all of those sorts of things that come into play because residential mortgages are regulated. But this isn't a mortgage. This is a different approach. So then, and that tax piece, that stamp duty tax piece, would kill it as well, perhaps. But yes, why
would you do this? Like, why is this efficiency in trading or
inheritance tax? Inheritance tax.
No, but I'm saying, but if we say that, okay, I don't know, Picasso, right? Tokens related to Picasso. Why would you? I mean, okay, we have this, let's say, so let's put it like...
Just using your Picasso example, how much is a Picasso? Don't know, £50 million. When it goes on the market at an auction house, you pay a premium, purchaser's premium, 10%, 12%, maybe more, don't know. So you're already looking at 55 million as the ticket price to get that. How many buyers are there actually out there in that exalted world? There's a number because these things do sell. 10, 20, 50, no idea. And then you've got all of the insurance. Well, could it be that if you attracted 2 million people, each of which is happy to pay £10 or whatever, which is my maths won't work out here, you've actually pushed the price up to 65 million or 75 million rather than the 50 million which you would have got through the auction. That's interesting. Still got the insurance of the thing. It still needs to be kept locked in a safe or whatever else it is. It's fine. And then when it comes to a different stage in the life cycle, it might be popped back out and somebody else wants to buy it. But now the price is 80 million. That's where you make your profit. So I could see that. But is it a long business? Is it a business with longevity? Don't know.
Yeah. No, there's some projects. I know one project in Germany, which is, the issuing token, so when you give the money, they're issuing the equivalent of this amount, and then they buy different, art, watches, all this stuff. And then it's actually almost like it's, frankly, it's UCIT. It's a slightly different, but UCIT, the collective investment scheme, right?
Yeah.
So that's something that I already see on the market, So it's also interesting, how, many, projects there are, and some of them have really excellent ideas, and they still don't go into the main, the kind of the mainstream, right? Because if you think of this, like, oh, we have this idea with paintings, and that could be done, so why don't we do this? We say that, okay, it's a problem from the regulator perspective, but somebody solved these problems, and it's still not picking up by the general public, So that's a couple of things, with crypto, and it's like, oh, it's crypto, so you have to be careful. Well, it's not crypto; it's different representation of rights, which is wrapped into crypto. So it's not crypto; it's something else, and it's already under the proper license, So, but it's still crypto. You know what I mean? It's like kind of, the bad rap is actually, impacting, the proper projects.
And that's what frustrates me here in the UK as well, is the press reporting, which is generally copy and pasters. Sorry if anybody's a journalist listening, but that's really what it is. And you just have to see the word crypto, well known for money laundering, unlike a £50 note or a £20 note, which has never been used for money laundering. And that's the way that everybody's been made to think by the press reporting, which is crypto equals money laundering, criminal money, and all of that sort of stuff. So you've got this big hurdle to get over, which is the PR of it. Wrong PR by the wrong people who are lazy. Don't actually know what it is.
All right. I think,
That's a good one, isn't it?
Yeah. Let's stop here.
Yeah.
Listen, thank you very much for this. It's excellent.
Thank you very much indeed for chatting away with me. It's great fun. Great fun. And hopefully I haven't been too offensive or opinionated.
All right.